To Foundations of Real Estate Financial Modeling. Today we're going to be going over time value of money, present value, and the concept of net present value. First, let's go over some definitions. So time value of money, that's the idea in finance that $1 today is worth more than $1 tomorrow. So you have $1 today, you could invest it in the stock market at a 7% annual rate. At the end of the year, you have $1.07, opposed to just winning a year for $1. Then $1.07 is clearly more than one single dollar. Then we go to the idea of present value. So this is the idea of bringing a future cash flow to today. So basically $3,000 in the future is not the same as $3,000 today. And to find out how much $3,000 in the future is today, we use the formula that you see here. So present value equals to the future value divided by 1 plus the interest rate, or the discount rate as sometimes it's known, all to the compounding period of that interest rate. With that, we jump into net present value. This is equal to the present value of all your cash flows. And in finance, if the NPV is greater than 0, then it's something that we would like to invest in. If it's less than 0, then we would not want to invest in. And if NPV equals 0, then we would be indifferent about investing. The formula for NPV, as I said, is the summation of all of your future cash flows. So it will be this section right here, minus your initial cost or investment to get these cash flows. Let's jump to some sample problems to wrap this thing up. So the first problem, what is the present value of $1,000 2 years from now with a discount rate of 3%? So we have the present value, and we know that this is going to be equal to $1,000 divided by 1 plus the interest rate, all to the compounding period, and we get a value of $942. Then we have the second problem, calculate the NPV from the following project with an outflow of $10,000 followed by an inflow of 3 years of $2,500 and a single inflow of $6,000 with a cost of capital of 9%. So 9% would basically be the discount rate here. We're going to use the Excel formula NPV, open parentheses. And we have the rate here, so we know this is 9%. And then we're going to do from the first year to the fourth year, close that out, minus the $10,000. Very important, guys, when we're using the NPV formula in Excel, don't include the negative value in your parentheses. The formula does not consider negative outflows when it was coded, so you need to consider it as a separate item in your formula. If you click enter, this will equal to $20,578.79, and since this is greater than 0, then this would be a project we would like to invest in. With that, I'll leave you guys to it. Thank you guys for watching. If you like the video, please like, comment, and subscribe. If you don't, comment, let me know what you didn't like. Let me know if there's something you would like to see. See you guys later for sure. Thanks, guys.